This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Sour apple. One day after hitting an all-time high, Apple shares have their worst showing in 7 months. And on the same day, rival Samsung unveils a palette of new products. Coincidence or not?
All revved up, auto sales accelerate in August on pace for the fastest rate since before the financial crisis.
And opening a door, why the rise of Chinese buyers may be creating quite an opportunity in the U.S. housing market. All that and more for Wednesday, September 3rd.
Good evening, everyone. Autos and Apple, these were the two big headlines today for investors on Wall Street and consumers on Main Street. Auto sales were red hot in August, giving a huge boost to the U.S. economy, and we'll have more on that in just a moment. But we begin tonight with Apple. Shares tumbled 4% today, and that almost single-handedly dragged down the NASDAQ Composite Index. Now, 1 week ahead of what should be a shining moment for Apple when it's expected to unveil the new iPhone 6, a cart full of bad news has combined to take the shine off Apple shares. They closed below $99 a piece just a day after Apple shares hit an all-time high of $103. The heavily weighted shares caused the NASDAQ to fall 25 points today. The Dow managed to squeeze out a gain of 11, but the S&P lost 1 point. So what happened today? One analyst told investors to take profits, saying he's skeptical that the company's product launch next week will result in, quote, massive incremental profit opportunities. But besides that warning, Apple is facing a lot of criticism about security after intimate celebrity photos were stolen from individual iCloud storage accounts. And then today, rival Samsung unveiled 2 new smartphones, including one with a side display for quicker access to apps.
Kim Forrest joins us now to talk more about all the issues that are weighing on Apple today and by extension on the NASDAQ today. She's senior equity analyst with Fort Pitt Capital Group. Kim, what are you doing? What is your company doing with its Apple shares and why?
Well, we didn't do anything today, but in the past we have been taking some gains if the amount of shares held is greater than 5%. We really try not to expose our clients to any single company news. So by keeping it 5% or less in any portfolio, that takes some of the sting away from days like this. So
it's being driven not by anything you see necessarily in the company, but by the fact that the stock has appreciated just so that it's above that 5% threshold.
Exactly, exactly.
All right, so let's talk a little bit about what is going on inside the company, because there have been all sorts of questions. Let's start first with the analyst report saying that unless this product launch does something to really show massive growth at Apple, you should be taking your profits. What do you think is going to happen with this launch next week? Because there's talk about the iPhone 6. That's out there, but also some kind of watch or wearable. Would that be a massive growth opportunity? What's your take on all this?
I think that the price that's baked into this stock right now and why it's gone up so far so fast on really very little news is because people are expecting another blockbuster item. Now, listen, this company has been able to convince consumers that they've had 3 products that nobody in the world has ever had before, and now we can't live without, right? So we have iPads, we have iPhones, and before that, for some of us, it was iPods. So I think we really have huge expectations for this new product, whatever it is, and that's very dangerous for investors.
Let's go back to that first question. If your company and you owned 0 Apple stock right now today, would you buy it?
Not right now, not at this price, and certainly not with all that risk. Owning stocks is really about mitigating risk and reward. And at this point, it looks like a blockbuster item is kind of baked into the results that people are expecting.
So Tyler keeps asking you about the stock, and I keep asking you about the product. So let me go back to the product.
We're double teaming her.
Yeah. What if there isn't a wearable announced on next week on the 9th? I mean, what if it's just the iPhone 6 that everybody's been expecting? Does the stock go way down after that? I mean, what happens?
I'm going to guess. See, that's a product and a stock question.
She's clever.
Anyhow, no, I think that really would be very disappointing to people. And I think we've heard some rumors, because this is a big rumor sort of stock, that even if it is a wearable or whatever the new device is, it's unclear that it's going to be ready for holiday 2014. And that's a big area, or a big time of year for electronic sales. So, you know, we have to keep an eye out on that, the timing of whatever the device is, what the device is, how expensive it is. You know, all of these things go into the formula of how hot this item could be.
This company's shares have had an amazing run of late, 38% or thereabouts since the spring. Is the bigger risk, though, Kim, that the phone, if it is a phone that comes out next week, isn't the blockbuster that they hope or that the audience expects from it?
Yeah, that's really huge as well. You know, they've been slipping in market share, not because they're selling less units, they are selling more, but it's just that other vendors have kind of come into their space and taken away their big mojo. So they need to have some real wow factor. I didn't really watch everything about Samsung today, but Samsung's really made huge gains in this area.
All right, Kim, thank you very much. You don't want to lose your mojo.
Thank you.
It's always a bad thing when that happens. Kim Forrest, Fort Pitt Capital
Thank you.
Group. Thanks again.
As we mentioned at the top of the program, August was a terrific month for auto sales, which rose more than 5%, marking the best August since 2006 and putting the industry on track to sell 17.5 million units this year. All of the major automakers topped analyst forecast last month. Phil LeBeau has more.
August auto sales came in much hotter than many people were expecting. In fact, the monthly sales rate of 17.53 million vehicles is the strongest monthly sales rate for the auto industry since January of 2006, when it was 17.62 million. And nearly every major manufacturer reported better than expected sales, with Chrysler leading the way. Sales jumped almost 20% last month for Chrysler, led by Jeep, which had sales increase 49% for the month of August. Nissan was up double digits, and really all of the manufacturers reported better than expected sales. What was driving it? A couple of things. Low financing. About 13% of all vehicles sold in July and in August, according to Edmunds.com, came with 0% financing. In addition, strong consumer confidence, which always is a key for driving auto sales, was another factor, and there still remains a lot of pent-up demand, with the average age for a vehicle in the United States running at nearly 11 years. Again, August auto sales, the pace, 17.53 million vehicles, the strongest monthly auto sales pace since 2006. Phil LeBeau, Nightly Business Report, Chicago.
And in the Federal Reserve's so-called Beige Book survey, which showed the economy got stronger across the entire U.S. over the summer, one of the biggest areas of growth was, you guessed it, those cars again, auto sales. 6 of the bank's 12 districts reported moderate economic growth, with the remainder reporting modest growth or signs of improvement.
Now, part of the reason for that growth, a stronger U.S. dollar. Since the end of June, the U.S. dollar index has risen 3.5% against a basket of other currencies. And as Sarah Eisen reports, with good economic data continuing to come in, the American dollar may be getting even more strength.
It's a paradigm shift. The U.S. dollar flexing its muscles at a one-year high against other major currencies like the euro and yen, taking off after a slow start to the year. The reason? Major central banks are seen moving in different directions. Hopes are rising that the European Central Bank will pump stimulus into the economy to prop it up, weighing on the euro, and that the Bank of Japan will do the same, weighing on the yen. While central banks pump easy money into economies, it dilutes the value of their currencies. At the same time, the U.S. economy is outperforming.
Especially here in the United States, the PMI data looks great. The factory orders numbers look great. The auto builds numbers look great. The employment trends look great.
The strong dollar has many implications for other markets, like commodities. It pressures gold and oil, which are priced in dollars and often seen as currency hedges. As far as the impact on stocks, stronger dollar could ultimately hurt, especially multinationals, where big chunks of sales come from overseas. That could hit consumer giants like Procter & Gamble, energy companies like Chevron, drug makers like Pfizer, and tech companies like Microsoft. One reason why some top strategists are telling clients to stay focused on domestic companies.
As an investor, you make sure you have plenty of your earnings coming from inside the U.S. After all, the economy is a bit stronger and broadening here, and then you don't have the currency contention. So that's what's dominated what I'm doing in my portfolios in order to benefit from the U.S. pickup.
Hedge funds and other large speculators are the most bullish they've been on the buck in years. Wall Street strategists say as long as the U.S. economic data continues to come in strong, especially big reports like Friday's jobs number, that could supercharge this dollar rally. But a lot also depends on central banks in Europe and Japan delivering on easy policy, both of them out with key decisions on Thursday. For Nightly Business Report, I'm Sarah Eisen.
Even with those looming central bank decisions and risks from a number of international hotspots, the stock markets are near record highs, fostering what some are calling a Fortress USA mentality. Steve Leisman explains.
Call it a Fortress USA mentality. The stock market hovering at lofty levels, while the news abroad ranges from economically dismal to militarily gruesome. ISIS on the march in the Middle East and Russian forces in Ukraine. Two international stories in the heart of the world's oil production. Europe, the world's biggest economy, teeters on the verge of recession, and the Federal Reserve in the U.S. comes ever closer to hiking interest rates.
Do you remember another time where there were more issues going around the world all at the same time, any one of which could overnight turn into a major disaster? You want to talk about ISIS, you want to talk about Gaza, you want to talk about the Ukraine.
And still, stocks march higher. So how realistic is this Fortress USA mentality? One of the biggest surprises has been the fall in the price of oil. West Texas has declined from $106 a barrel in mid-June to around $93 today. That could be because the U.S. gets less of its oil from hotspots. Imports from Canada and Mexico in U.S. oil production now equal nearly 70% of U.S. consumption, up from below 50% in 2000. More stable oil sources mean less volatility from the horrific foreign headlines in oil-rich countries. And as Europe's economy has sputtered, U.S. growth has strengthened, with 4.2% growth in the second quarter and third quarter growth seen in above trend 3%. Markets seem pretty certain that an aggressive European central bank is about to spring into action to save the continent from recession and deflation, and that U.S. economic momentum can last.
With the evidence of the U.S. economy strengthening more and more, we're going to be creeping towards a position here where the Fed might get even less dovish than it's been recently, which could cause bond yields to rise earlier, and that, if it happened, would be a challenge for markets as well. So, as much as it's good to see the economic story improving in the US and doing okay elsewhere, I don't feel my normal, usual bullish self about markets at the moment.
And still the market marches higher, despite full knowledge that the Fed is set to reverse course in less than a year and some risk it happens sooner. And the doomsayers could yet be proven right. Fortress USA could turn out to be a castle built in the sand, but so far it's withstood serious challenges from the rest of the world. For Nightly Business Report, I'm Steve Leisman.
New rules for the nation's biggest banks from the Federal Reserve and other financial regulators. The 15 largest banks, each with more than $250 billion in assets, are now required to keep more cash, treasury bonds, and other so-called liquid assets on hand, enough to continue operations for 30 days in the event of another economic downturn. Smaller banks will have to keep enough assets on hand to cover 21 days.
And coming up, it's been a bit of a tough go for retailers of late, but there is one category of stores that could be primed to outperform. We'll tell you about which ones they are a little later.
Some big changes at CVS Caremark today. The chain has pulled cigarettes from its shelves a month ahead of schedule. The company is also changing its corporate name to CVS Health. The CEO says this will bolster CVS's image as a healthcare company.
Certainly people view us as a healthcare company, especially in light of, the decision. I think it further makes a statement and a commitment to, our focus on health. We've had a very successful selling season this year. We've been awarded over $5 billion in new business, and you still got to be right on price, you got to be right on service, but some of the other things that we're doing we think are more than an intangible in terms of why people put their trust in us.
The stock was up almost 1% to $80.36.
Get ready to pay more for health care. New federal figures show that the growth of U.S. spending on health care was up just 3.6% last year in 2013 to nearly $3 trillion. But with a rebounding economy and expanded coverage under the Affordable Care Act, that spending growth is expected to increase to a 5.6% rate this year, then taper off in 2015, and then rise more than 6% from 2016 through 2023. This as the U.S. population ages and more Americans have coverage.
We're just 2 months away from the midterm elections, and one of the closest races for control of the U.S. Senate is in the politically divided state of North Carolina. And tonight, the first debate between the incumbent Democratic senator and her Republican challenger. John Harwood is in Raleigh, North Carolina, ahead of tonight's face-off. So, John, a lot of people are watching this race and this debate. What makes North Carolina representative of the broader contest that's going on in the Senate?
Susie, the fight for control of the U.S. Senate is going to come down to states with Democratic incumbents that were carried by Mitt Romney in 2012. It's true in Arkansas, it's true in Alaska, it's true in Louisiana, and it's also true here in North Carolina, where Kay Hagan, first-term Democratic incumbent, faces a state electorate that has moved somewhat to the right since she was elected in 2008.
So from 2008 to 2012, if North Carolina became a red state in those years, why do Democrats think they can hold on to this particular seat?
Well, even though Kay Hagan's on the defensive for Obama's domestic problems, Obamacare, deficit spending, that sort of thing, his international problems, you've got Tom Tillis, who is the Speaker of the North Carolina House. He's the Republican candidate. He's on the defensive for things the North Carolina legislature's been doing, which are also controversy. Budget cuts, tax cuts, curbs on voting procedures. All of these have created the same kind of controversy here in Raleigh that there is in Washington. Lots of unhappy voters on both sides.
You listed every possible issue that they could be debating on, but if you had to divide it up between U.S. economic, domestic issues or international issues like what's going on in the Middle East, which one do you think dominates?
Susie, so far this race has been dominated by domestic and economic issues, both in Raleigh and Washington: budget, spending, taxes, health care. But we're going to see at this debate tonight, an hour-long, beginning at 7 p.m. It's going to be televised on C-SPAN as well, whether or not the brutality of ISIS is changing the focus. Certainly, we've seen a lot of Democratic senators under pressure to distance themselves from President Obama on this.
Well, it's a fascinating race. John, thanks so much. John Harwood, reporting from Raleigh, North Carolina.
Shares of Delta slump after the airline cut its outlook, and that is where we begin tonight's market focus. The company warned that it expects jet fuel prices to top previous estimates in its third quarter. It also lowered its projections for a key passenger revenue metric and its operating margin growth. Shares down 5%, 38.82, worst performing stock in the S&P 500 index today. Infinity Pharmaceuticals soared after the company said it would receive an upfront payment of $275 million from AbbVie, this as part of a new collaboration to develop and commercialize its treatment for blood cancer. The CEO says its targeted therapy and others like it are getting drug makers closer to a cure.
The next frontier for the treatment of these diseases, which is combining our targeted medicine with other targeted medicines. And we think that that has the potential to take patients from a life-threatening condition towards, in the near term, living with their disease as a chronic condition and ultimately getting to more curative outcomes.
Shares were up 44% to $15.73. Well, it looks like Tesla, the electric car maker, will be opening a battery factory in Nevada. It hasn't been confirmed yet, but the state government has scheduled a press conference for tomorrow, where it is expected to announce that Nevada is the site where the proposed $5 billion factory will be built. Tesla shares were 1% lower to close at $281.19.
Shares of Netflix hit a record today after the company struck a deal with Time Warner and Warner Brothers to secure the streaming rights for the Batman prequel, Gotham. Now, the deal is different because Netflix has landed the rights before the series has even aired. Shares edged up a fraction but closed below the all-time high at $477.39. A positive research note from Morgan Stanley helped push Mobileye higher. The firm said the software company could be worth $100 a share by the year 2020 if it can keep close to its current market share. Mobileye makes cameras used to avoid car crashes. Shares soared 9% to $46.97. Lumber liquidators also higher after Wedbush upgraded the stock to outperform from neutral, saying the worst of the company's supply chain and competitive issues are behind it. Shares of the flooring retailer jumped 7% to $59.28. And the board of TIPCO Software announced a review of strategic alternatives. Now, that usually means it wants to put itself up for sale. The company, which provides business intelligence software, has hired Goldman Sachs to assist in that review. Shares fell a fraction to $21.04 and then surged in after hours, trading on the news.
The back-to-school sales are winding down, as so many kids are back to school already, and retailers are gearing up now for the big holiday shopping season. But with gross margins tight and getting tighter, stores are fine-tuning their inventories right now. So which retailers are poised to get it right and outperform the sector averages? The answer may surprise you, and Courtney Reagan has it.
Planning retail inventory can be like pleasing Goldilocks. Too much merchandise bogs down the balance sheet and makes for a frustrating shopping experience for consumers. Too little inventory opens the possibility for lost sales and leads consumers to look elsewhere. The financial crisis and the following years taught retailers a number of lessons, including the power of promotional events to move excess inventory and the dangers of buying too much. Now, analysts say retailers are hitting it just right with some of the leanest inventories seen in a number of years. Deutsche Bank says department store inventories were up just 1% in the second quarter, the lowest increase in nearly 2 years, which has helped profitability at stores like Macy's, and according to historical data, should trickle down to off-price names like TJ Maxx and Ross stores.
What we expect to happen in the future is that the off-price retailers will see better gross margins and better same-store sales because they're going to be seeing less competition from the department stores.
Retailer Ross Store says inventory is 40% lower than in 2007.
This strategy has made it easier for our customers to shop our stores and has driven sales by increasing the percentage of fresh and exciting bargains they see when they visit our stores. It has also enabled us to achieve record merchandise margins through faster inventory turns and lower markdowns as a percentage of sales.
While leaner inventory may make it easier for consumers to sift through the racks, it may lead to fewer promotional offers. The better retailers get at determining that just right level of inventory, the less they'll need to put on sale. For Nightly Business Report, I'm Courtney Reagan.
Chinese buyers have been a big presence in the U.S. housing market, and now they may have created a big opportunity. We'll explain in a moment.
Home builders have had a spotty year so far, but today the luxury home builder Toll Brothers reported a blowout third quarter. Net income more than doubled to nearly $100 million over the spring as it delivered more new homes at higher prices. The average cost of one of Toll's newly constructed units rose to $732,000 from $651,000 just a year ago.
Chinese buyers have been flocking to the U.S. housing market, looking to park their cash in a safe place, while at the same time hoping to enroll their children in American universities. This has created opportunities for both U.S. and Chinese developers, and some of them are now working together. Diana Olick has more.
The Chinese have been buying U.S. real estate, and now they are building it. Chinese developer Landsea is planning to put 200 condominiums in this site overlooking the Manhattan skyline.
The Chinese real estate market is very competitive, and the U.S. housing market is growing and recovering or expanding rapidly. So for us as a company to invest a certain amount in the United States makes a lot of sense for us.
Landsea, which calls itself China's preeminent green builder, is putting about $1 billion into the U.S. housing market, beginning with 3 developments. This one in Weehawken, New Jersey, will be condominiums with priceless views. It also plans to build townhomes in San Francisco and single-family homes near Los Angeles.
The reality is that these are very big companies. They're well-funded. The U.S. we think it's a good market. Obviously, we're in it. Right. So we shouldn't be surprised that they've come.
Lancy, which has 40 developments in Asia and Europe, is centering on markets where job growth and information technology is strong.
Our primary customer is still here domestically in the United States, but because of our background and who we are and our brand in China, we will get Chinese customers who will want to buy our homes.
That's why they admit they're also focusing on markets with well-known universities. Chinese parents have been inundating new developments in Southern California, buying homes so their children can attend school there. Builders like Lennar have cashed in on that market. And now Lennar, which sold Lancy this neighboring lot for the Weehawken project, is going one step further, working with Lancy to both design and build the condos. They'll use domestic workers and materials and build much in the same style as the Lennar units already here, all in a bet to bring in buyers from both sides of the globe. For Nightly Business Report, I'm Diana Olick in Weehawken, New Jersey.
To read more about Chinese developers who are taking on the U.S. housing market, go to our website, nbr.com. And that is Nightly Business Report for tonight. I'm Susie Garrow. Thanks so much for joining us.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody, and we'll hope to see you back here tomorrow night.
I'm Susie Garrow with the Nightly Business Report News Brief. Auto sales were red hot last month, the best August in more than a decade, with the industry on track to sell 17.5 million autos this year. Apple shares tumbled 4% after an analyst recommendation to sell the stock, worries about security of its iCloud storage service, and after rival Samsung took the wraps off two new smartphones. On Wall Street, the Dow gained 10 points. The fall in those Apple shares caused the Nasdaq to fall 25 points. The S&P lost 1 point. Financial regulators approved new rules for the nation's banks to have more cash and bonds on hand in the event of another downturn. And after ending sales of all tobacco products, CVS Caremark changed its corporate name to CVS Health. Be sure to tune into Nightly Business Report right here on your public television station.